Hello and welcome to episode 149 of Simply Tax. It's Thursday, September 8, 2022, and today we're talking about our friend Annalise. Now, she's been delayed a few times in showing up, at least for private companies and private nonprofits. But she's finally here, and hopefully her name rings a bell. No? You know, a new lease standard from the FASB? All right. We have a limit of just 2 dad jokes for this episode, I promise, so I better save one for the discussion. But under the FASB's new lease standard, lessees are required to recognize all leases with terms greater than 12 months on their balance sheet as lease liabilities with a corresponding right-of-use asset effective for fiscal years ending after December 31, 2022. And so, I'm excited to share with you on the podcast today a conversation I had with John Kmetz, who is the national leader for FORVIS' private equity team, and Phil Laminack, a director with FORVIS and a leader in the firm's National Tax Accounting Services Group, discuss Annalise Standard, and offer tips, tools, and guidance for implementing and even making the most of the implementation process. Enjoy. I like to do a couple warm-up questions because I think that's always kind of helpful. So maybe, John, we'll start with you. A hobby or a pastime or something you do outside of the office for fun?
So I'm a lake guy. I love just getting out on the water and surfing with my kids during the summer. I'm also a big wine guy, so I like wine tasting and drinking wine. And in general, if I can drink wine while surfing, that's probably even better. I would say that's what I spend most of my free time doing.
That's a talented thing. If you're doing those two things together, that's pretty awesome. Do you have a particular varietal that is your favorite from the wine perspective?
You know, I spent a lot of time in Portland, Oregon, so I'm a little partial to Oregon Pinot. But, you know, I'll drink red, white, rosé. I'll do all of them.
As long as it's good, right? Is it the standard?
Goodish. Anyway. Yeah.
So, all right. How about you, Phil? Favorite pastime or thing to do outside of the office?
Yeah, I love to get outside. There's a lot of great places north of Atlanta to go hiking. So that anytime I've got a free Saturday, you can usually find me up in a state park somewhere trying to get a hike in.
Awesome. I don't know, we're on the topic of leases, and this is kind of tangential, but I don't know. When it comes to cars, are you more of a lease or are you a buy kind of guy? John, what do you think?
So I grew up, we didn't have much money. So every car I owned was a little bit suspect. But it was always a cheap purchase. So now I like to buy high quality cars. I don't lease, I buy, but I drive them forever. So I'm in my 16th year with FORVIS now, and I'm just on my second car in that time, which I am going to drive until my 12-year-old can take it. And
there you go.
So I'm a buy guy, not a lease guy.
I like it. How about you, Phil?
I would say pretty much the same thing. I've never leased a car. I like to buy a nice car and keep it for 10 or 12 years and until it starts to need maintenance, and then it's time for the next one.
Can maybe wrap up one last question. Phil, I'll start with you on this one. What do you enjoy most about the profession and what you do?
I would say my favorite thing about the public accounting profession and what's kept me in it is that we get to learn something new every day. I've been in the profession for about 17 years now, and there's still not a day that goes by that I don't feel like I learned something new or I saw something I've never seen before. And that gets me excited to get up every morning thinking about what am I going to learn today? How am I going to be better at the end of the day than I was at the beginning of the day?
John, let me start with you on this, and maybe just to kind of back up on the topic here that we're talking about. And let's just talk about this lease standard. What is it and who does it apply to?
The new lease standard, essentially, what it does is takes all leases that a company has entered into and it requires them to account for these on their balance sheet. In the past, if you had an operating lease that you just signed a lease, you're just paying rent, you would just recognize rent expense on a monthly basis. So nothing was on your balance sheet. It was kind of an off-balance sheet contract and you had expense every month. Now companies will have to record a large liability for the present value of the future lease payments in that contract. And then on the offsetting, they have a large asset for essentially their right to use that asset during the lease term. So essentially, you're doing a big gross up on your balance sheet, and then those assets and liabilities are amortized down over the lease life. There's an interest component in there that gets recognized differently depending on if the lease is classified as operating or a financing lease. So the big change is putting these things all up on your balance sheet, but there's a little bit of devil in the detail on how the calculations get done on the P&L side and then the associated additional disclosures that the standard have. So that's what the lease standard is. Who it applies to, I won't go into all the history and the background of where we've been with this, but it's been a long time coming and it's been deferred multiple times. So we're here now. Our SEC clients had to adopt this in prior years, but now that GASB and FASB standards are causing all of the rest of our clients to have to adopt it this year. So our teams and our clients are going to be really busy getting this done between now and end of the year and when they get their audits or reviews out.
Trying to just give a better picture of I guess if you look at the liabilities associated with these lease agreements, essentially. Is that a fair way of looking at it? Okay.
100%. And we've been talking to audit committees and clients about this for years. And this was all part of the same efforts where revenue recognition converged with the U.S. standards and IFRS. And there was years ago a big effort between the international and American standards to try to converge. This is one of the projects that came out for various reasons. The can got kicked a little bit, but it's here, and there will be no more deferrals. We are neck deep in it right now.
Okay, so it's like you said, it's here.
Time's
so
now.
Maybe just talk me through what it looks like to adopt it, and really probably just maybe understanding work that maybe needs to get done there. So what the lift looks like for the team in terms of actually getting that standard implemented and wrapping your arms around it.
It depends on how many leases, right? There might be an entity with just a couple leases, and this might not be a big deal. But essentially, what all companies are going to have to do is pull together an inventory of all the leases they have, which that in and of itself can be a little bit cumbersome because you might have leases that meet the definition in the standard that you might not have considered leases before. You're basically going to inventory all these things, and then you need to take those and put them into some kind of a tool, spreadsheet tool. We've got a tool called Lease Vision that makes the calculations fairly easy, gives you the disclosures, gives you all the information you need. So you need something to assemble this thing into to apply the standard to these population. And then there's some judgments to apply, right? There's some, it's not just no-brain work. You got to pick your interest rates, and there's some different details to figure out the term of a lease. For instance, if you have an open-ended lease, what is the term of that lease or your expected term? And then take all those things, apply what your policies are going to be. And the standard is good in that it gives you some shortcuts in transition and your accounting policies. Come up with your disclosures, and then finally dump this all into your financial reporting so that for the clients that get an audit, then your auditors are going to have to look at it and validate all this. So pulling the data, selecting a tool, doing the actual accounting and financial reporting, it's a little bit burdensome if you have more than just a handful of leases.
I'm sure, and like you said, there's just even just the thinking that through kind of in some of the areas that require a little more judgment or understanding, and maybe even is just gathering the data, because I think in some cases, perhaps sometimes this information isn't or hasn't historically maybe been as readily made available or tracked in companies. Is that a fair assessment?
Very fair, and I think it's Pareto's principle, right? 80% of this is probably easy to pull and find, and there might be some leases that I think some of our clients have found they have leases they didn't even know they had. Getting that data, just starting with a complete population to even start applying the standard to has been a little bit burdensome. And then you need someone to do it. Obviously, it's something that we are willing and have been helping our clients do, but somebody's got to go through and apply this accounting to all the population.
All right, Phil, this is a book concept, right? But I mean, let's talk tax. What's the tax angle here? What's the considerations on the tax side?
From a tax accounting perspective, we start with what is the income tax treatment of the lease. And for tax purposes, we don't really have the concept of a capital lease or an operating lease. We have something that either is a lease or we have something is considered a disguised sale for tax purposes. So the vast majority of these leases, whether they're capital or operating financing type lease under the new standard, for GAAP purposes, most of the time for tax purposes are going to be just considered a tax lease, which means that for tax purposes, there's nothing on the balance sheet. We've got rent expense, that's it, nothing on the balance sheet. So now for GAAP purposes, as we're putting on the balance sheet a right of use asset and we're putting on the balance sheet a lease liability, well, now you've got two items on the GAAP balance sheets that don't exist for tax purposes. And that's going to give rise to deferred taxes. So for companies as they adopt the standard, historically we've been used to seeing deferred tax assets and deferred tax liabilities for those capital leases, not for operating leases. Going forward, we're going to see deferred tax assets and liabilities for both types of leases, where you have that right of use asset on the balance sheet. Well, that's a GAAP asset that has no tax equivalent, so that's a deferred tax liability. My lease liability, that's a GAAP liability that doesn't exist for tax purposes, so that's a deferred tax asset. So I'm going to have a large DTA, a large DTL that will closely net each other down, but not exactly, because the different discounting, the different way you do the future values and all of that, that right of use asset and that lease liability are not going to be exactly the same. So when companies adopt the standard, they're going to be putting up a DTA and a DTL that don't net to zero. And so you're going to have a residual tax effect that's going to go through equity as part of your opening adjustment when you first adopt the standard and implement that. So there will be new deferred taxes that go onto the balance sheet when you adopt the standard, but then also on a go-forward basis, there's going to be tracking required to understand, okay, if I have rent expense for tax purposes, but for book purposes, I have amortization of a right-of-use asset, I might have an interest component, so I'm going to have some different book tax differences that I'm going to need to track on a go-forward basis that really needs to be part of the equation and making sure that the tax team is staying in sync with the team that's doing the lease implementation to understand how that's going to fit into the tax reporting cycle.
If I can jump in with what Phil just said on the ongoing tracking, it's a great point and something that I think is also getting missed in that there's a reassessment that this isn't a one and done thing, right? Clearly on the deferred tax side, it's something that they'll have to track throughout the life of these leases and our asset and liability on the book side. And then there's a reassessment that happens every year as well, which then can also on the flow through, if we adjust our lease liability or our right of use asset, that is also going to flow through. So there's, as the judgment and assessment could change any particular lease in any given year, then there's always the flow through on the tax on top of their ongoing, just treating the regular deferred tax asset or liability amortizing.
As we're talking about tax, are there any planning considerations with regard to it? I mean, obviously on the book side, right, John? I mean, like you said, time's here. We got to adopt. So there's not a lot of, maybe some planning for the work to be done, but you've got to do it. What does that look like on the tax side, if there's any things to be thinking about there?
Yeah, I would say there's less planning opportunity than there are traps for the unwary of just making sure that you're thinking through getting all this on the balance sheet. I mean, where we do see some tax planning opportunities around leases, a classic example is a company that has maybe significant tax attributes, NOLs, tax credits, things that are going to expire unused. And maybe there's an opportunity to do a sale lease back on a property. Maybe for book purposes, it's a continuation of the lease, but for tax purposes, you can structure the contract in such a way that you get sale treatment for tax, perhaps trigger significant taxable income, take a step up tax basis in the property and offset, use up some of your tax attributes. That's a planning strategy that we see used from time to time. But again, that's more just in terms of structuring the leases. In terms of the new standard, I would say it's more just making sure that companies are prepared to do the tracking and understand the deferred tax implications of that.
Gotcha. Yeah. So when you look at that and structure into the sale, I mean, it's kind of a facts and circumstances analysis essentially, right? As to whether something falls into one bucket or not. I don't know if there's anything you'd add to that, because again, understanding those thresholds is probably pretty important for structuring that. So it sounds like, if I don't put words in your mouth, that probably something you're going to want to have a conversation about in advance to make sure that you're dotting the I's and crossing the T's, so to speak, from a facts and circumstances perspective. Is that fair to say?
Yeah, absolutely. Because the tax rules around a disguised sale, there's no one code section or one regulation you go and look at. That's all defined in case law. And you look at things like, for example, is there a bargain purchase element to the contract where either title automatically passes or at the end of the lease there's a right to purchase that is so nominal that you would assume that any rational person would exercise that contract. Are the fair market value of the lease payments, do they exceed the value of the property? There's other things that have been pointed to in case law that you could say, okay, if I have one of those elements in my contract, then I can point to, okay, here's judicial authority for me to consider this a sale for tax purposes. But it's definitely not black and white. Certainly facts and circumstances dependence, and something you want to make sure that you're looking at with your tax advisors to make sure that you've got that structured to get the treatment that you want.
There's one other thread I want to pull on here that you mentioned, kind of the traps for the wary. Are there any other maybe tips that you would give in that area that maybe this lease adoption of a standard maybe can trip?
I would say the most important thing is to understand what the GAAP accounting is going to be, not only on the date of adoption, but how it's going to unwind over the life of the lease, to understand what is going to go through the P&L for book purposes. Are you going to have amortization expense? Are you going to have interest expense? How are the cash payments going to be divided? And that you've got a clear mechanism in place to track those compared to what my tax items are going to be. If you've got interest expense coming through the P&L, but it's associated with a lease that for tax purposes, we're getting a rent deduction instead, we need to make sure we're tracking that. We understand what portion of that relates to those leases so that we're taking the right book tax differences and not duplicating or taking interest expense for tax purposes that we're not entitled to because we've got our rent deduction. And if we don't create a book tax difference for that interest, we might be double dipping on the benefit there. So I would say that the tracking really is the biggest piece of it on a go-forward basis.
So John, thinking about just this implementation in the lift, I mean, what are you seeing as maybe the biggest challenges or the biggest questions or concern maybe that you're hearing from the CFOs and the clients that you're working with?
Good question. I think the biggest challenge right now is just getting started, like we kind of started off with, just getting people out of the gates and going on this, because it has been kicked so far down. But if we can get people started on it, really, the mechanics of this are not that hard. The debits and credits, there's some nuances and whatnot, but to get this down it's not a terribly complex standard. And I think I mentioned earlier that there are some practical expedients that they've offered to help implementation go a little more smoothly, just on not having to go back and reassess old leases with hindsight if you don't want to, and taking an interest rate that is a benchmark. So there's some things that I've done that'll make it easier. I think probably the biggest challenge has been getting people started and maybe identifying all the leases. Like I said, with that initial population, there's been a little bit on embedded leases, and that would be a situation where you have, one of the examples is a vendor with your Coke machine, right? And you're paying them the service of coming and filling it. You're paying for the Coke. Are you leasing the machine though? It's the machine that's been in your break room for the last 10 years. Or do you have control of that? So there's nuances like that where you have to consider, as a service contract really a lease and you're controlling an asset. Those are things we can help people work through, because this is a first time around for this and people haven't dug into it yet.
Yeah. And I mean, even thinking around the conversations maybe with the bankers, and I don't know if you're hearing anything from those conversations, because obviously this impacts the financial statements. It's going to the bankers, and any thoughts or observations you've had so far on that, or if there's maybe even just words of wisdom to CFOs and tax directors around communicating to the bank around the adoption of the standard?
I'll let Phil comment on the tax directors. I would say the words of wisdom are, regardless of how this is going to impact your financials, it'll impact everybody, right? Even if you have just a few leases, it may not be material, but for most of our clients, it probably is. This standard has been in effect for a calendar year-end company since January 1st. So my words of wisdom are probably get it done now, because when you get to the end of the year, the financials are going to change, the look's going to change. Most investors are aware, right? We've been talking about it in audit committees or whatnot. But if I'm the CFO, I want to get those changes in the books when I close them after December, so that people can start to get comfortable with what we've got in there, and we're not surprising anybody after year end when we're going through our audit process. And then actually, you mentioned the other big one. I think most of the bankers know this is going on. Most of our clients have probably been talking with them. So as it affects like debt covenants, that's probably been factored in already. But if it hasn't been, you absolutely want to talk to your banker before year end. So I'm thinking investors, I'm thinking bankers. I work in a lot of private equities. So just as you think about some of the covenants that those two groups might have, making sure you're all on the same page before 12/31, not April.
I don't know, Phil, yeah, well, anything you'd add maybe to that tax director crowd?
Yeah, my advice to the tax directors, VPs of tax out there would be stay in front of this and have a seat at the table. Too many times, if the tax folks aren't proactive, they're the last ones that find out about what's happening. So it's very important that they stay in lockstep with the folks that are doing the implementation, that they understand what the systems are, what the population of the leases are, that they're part of that conversation on the front end and not just trying to figure out the tax accounting on the back end, because understanding the process on the front end for GAAP purposes is really the most important part of being able to get the deferred tax accounting right.
Yeah, the more you kind of put off and the more you're kind of doing in hindsight, it's hard, right, to kind of build that picture, and that's essentially what you're doing. But, John, earlier you mentioned that there is the lift there and that you've been helping, the team's been helping. What does that look like? How have you been helping, and in what ways are you able to help and add value?
Probably the three things we can do. Number one, just proactively engage our clients in that discussion, right? And make sure that they're doing something, that we're not just sitting around waiting because we don't want this to get implemented during crunch time for them. Just the conversation, I think, is helping. But there's probably two things I've seen in addition to that. Number one, I mentioned this lease vision tool we developed in-house, and there's a number of softwares out there. And if you have a lot of leases, there are software companies that help you manage that. If you have hundreds and hundreds of leases, like some of our clients do, that hopefully they've adopted and implemented already if they have that many leases. But our Lease Vision tool is an Excel-based tool, real user-friendly, what our finance teams are used to working with, that'll take you kind of soup to nuts for this. So if you've got 50 leases, this is probably a really cost-effective tool from FORVIS that'll help you. You still have to pull all that data and get it in, but then the tool will calculate everything you need. It makes it easy to audit too, whether we're doing your audit or someone else is. The last thing we've seen on the heavy lift part is once people understand the lift, a lot of them have been asking us to help. So again, whether using our tool or not, getting just staff accountants to help pull data. At the end of the day, the companies that we're working with still need to get in there. We probably can't dig through their files and find their leases for them. But once they have them, we've got a tool, an AI tool that we use that will help read them and pull out the pertinent data so we can real cost effectively help them with that input once you've got that all. So those are probably the three things that I've seen, just the conversation, the tool, and then the data grind.
For the matter of, those that are out there that start thinking through things like independence, like how does that interact? You said if there's an audit involved in providing the tool and assistance, where's the line there, John, and how does that work?
Just like anything else, and I think on the tax side, a lot of times you guys will run depreciation schedules, for instance.
Right.
So if we're doing calculations and things like that, or just data entry kind of things, usually not a problem, right? We're always careful and make sure we structure that engagement properly. The tool itself, and I kind of refer to some of the judgments that management has to make. We would make sure that management is always making all those judgments. So it's a tool they can buy from us that they can use, but it's an Excel-based tool where any of the inputs that take any judgment or management decisions is still in the hands of management. So that's how we've been managing that. So my caveat to that is, and as I said, the SEC companies already had to do this. We couldn't do this for an SEC company that was also our assurance client because those rules are more stringent, or the fiducia rules, for instance. But if you're getting into what we're dealing with, like a typical AICPA type of independence issue, not an issue. We can do that as long as management is still owning the process and making all the judgments.
Because the SEC clients have already adopted, I mean, are there any lessons learned that you would offer as just advice at this point in time for those that haven't yet adopted, or maybe just kind of hearing this and thinking, I need to get around to doing that and figuring that out?
As silly as it sounds, it was more than most people thought it was. So the lesson was the longer you wait, and I know I've said that 3 times, but the longer you wait, this could bite you with some of the details. So I think our SEC clients have found, that took a little more of a lift than they thought. There's a little more ongoing process than they thought, right? You want to make sure that your procedures and controls are sort of in place to be able to handle that information and the ongoing judgments, not just the transition adjustments, but the ongoing adjustments, the amortizations, and the judgments that it takes to evaluate and reevaluate your leases, that you have a good process in place. I think our SEC clients are good at that, right? They've gone through Sarbanes-Oxley and things like that, sort of made them refocus that. I would say that's probably a lesson they learned. This wasn't just a one and done. It's just a new way that we're going to account for leases forever. So we got to have good processes in place to do that.
So maybe kind of full circle here, bringing the whole conversation to a, kind of putting a bow on it, I guess, if you will. Phil, is there anything that maybe we haven't touched on, first of all, so we make sure we touch all the issues, but second of all, that you would leave our listeners with as a kind of a closing thought?
I think we've touched on all the important stuff. I guess my closing thought would really just be the same thing that John said, that being proactive and being in lockstep with the GAP folks as they work through all this would be my best advice for the tax team. And then also for the GAP folks as they're thinking through the implementation, just don't forget to bring tax along. If your tax folks aren't reaching out proactively, reach out, get them involved in the discussion so that there aren't any surprises after the fact.
Good advice, Phil. I've always said a tax guy or a tax gal is good to bring along to a cocktail party. So, it's good to bring along to these conversations about leases as well, right? Or something like that.
Yeah, no, I love that. I like to bring tax people to cocktail parties.
We're the life of the party.
That's right. That's right.
John, how about you? Kind of, anything we haven't covered, as well as any closing thoughts that you leave everyone with?
Besides get started now, which I think we have touched on, but I'll say it one more time. Now is the time to get going on this. The one thing I would say, it's in the eye of the beholder. So if you look at this as an operational opportunity, right, as for our companies, as a chance to improve or look at your operations or tighten some things, I think that's a place where you might be able to find a little value add in a otherwise compliance type of standard. So as you have that inventory of these types of contracts, when you see it on the whole, right? We haven't ever pulled this population together quite in this way. Maybe it helps you make a lease or buy decision, right? Like we started with. Are there just operationally, are there things that you're paying for? I don't know if I can liken it to Netflix, right? Where it's just some of those things where I sign up and they're just running monthly, but I may not even need them. There's some opportunities to relook at that. And if our clients and the companies we're working with are sharp, I would use this as an opportunity, not just a compliance exercise, to really look at those things.
That's a great point, right? I mean, especially in this environment, with managing costs and whatnot, using it as a tool and a resource as well as just going beyond the exercise from the compliance standpoint. That's a really good point. So I do want to ask John, how can someone that's listening learn more about the standard and even the ways that we can help here?
First of all, I'll say for any of our clients, the FORVIS clients out there, pick up the phone and call the professional serving you, call the team. We're all over this right now. It's hot. Our teams across the board are working on this. That goes for our tax clients, right? We have plenty of tax-only clients. If they have any sort of financial statements that they are publishing and they're listening to this, talk to your tax professional. They'll grab an assurance person and we'll help you get this done. So for our clients, it should hopefully be very easy. We've got all kinds of easy buttons for them through this process. So that's number one. And if we're not working with you, feel free to call me directly. I'll help you. But on our website, there's some communications. If you just Google FORVIS and lease accounting, you'll find that there. We've got some resource centers. And again, even this tool I'm talking about with Lease Vision, we'll run a quick demo for you. It's one of those things, it's Excel based. You could be using it this afternoon, right? If I show it to you this morning. Mechanics are not that hard. You just have to start. You got to get somebody who knows this, have them help you get started on it.
All right, that's it for today. But please check out the show notes of this episode available at forvis.com/simplytax to learn more about the new lease standard and to get the link to an upcoming webinar where you can get your questions answered. Oh, and be sure to also check out the show notes to get the contact information for John and Phil. Lastly, we want to know what you think about the podcast. Connect with me on social media to share your feedback. You'll find me on Twitter where I tweet about tax at Damien Martin CPA, on Instagram at TaxDad, on YouTube by subscribing to our Simply Tax YouTube channel, and out on LinkedIn. Please also leave us a rating and review on Apple Podcasts. I'm Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. FORVIS is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.